I would like to start with AI, since it's on everyone's mind. So we see this divide between the camp that says we're in a bubble and the camp that says, no, we're not in a bubble. So what are your thoughts here?
If you look at the relative performance of the US tech sector, we saw a very strong outperformance of the tech sector in the late 1990s. Of course, we're aware of that, but we didn't see an outperformance in earnings for the tech sector relative to the US market. So you saw a big gap opening up between those two variables. And that was the bubble, right? So if we fast forward to today, what we're seeing is actually tech earnings on a relative basis are in some ways actually outpacing the outperformance of the tech sector. Valuations look a little bit more pricey, I guess, but we think that's validated by the strong fundamentals going forward.
At Amundi, we feel that AI is a structural theme. It's not a macro bubble. And if you look at the amount of AI-related capex in US alone, it represented 0.8% of GDP last year. So we're only at the very beginning of the capex cycles in US. Some of our clients may say that, but the valuations of some of the AI stocks in US are expensive. And this is when we can redefine AI to say that AI doesn't mean US AI. You can also invest in China, for instance, or outside US or China. This year, we really would like to encourage our investors to relook Europe because there are certain elements that have changed versus before. I think besides the fact that we saw how German fiscal reforms is now changing encouraging the other country to increase their EU reform, and we're also seeing the improving fundamental in Europe more and more by more and more countries by and large. I think we recognize that international investors are now trying to avoid over-concentration on US assets. In the case of Europe, we also have a huge sector that now is rising sharply, is the defense sector. So it's likely to benefit from the multiple years or even decades of focus, not by just one or two countries, but by the whole ecosystem of companies that manufacture the screw, the tapes, and many other materials required to improve the defense of the European Union. Last but not least, we also like the industrial and financial in Europe because they are offering higher cash flows, higher dividends compared to many parts of the world.
We're sort of taking a bit of a barbell approach within the US. So yes, we're overweight tech, but we're also overweight healthcare. Actually, we're overweight healthcare globally.
Right.
So obviously much more defensive. We think the regulatory headwinds for that sector are easing. So from that perspective, we think it's a good thing to have in the portfolio just to counterbalance. If you did see some disappointment on tech, maybe this would be more resilient. In the US as well, we like utilities. So obviously power generation, and it's related, usually utilities is very defensive, but obviously there is an AI element to this due to the power generation required for AI. But those are the three sectors in the US that we're overweight, and that's how we're sort of positioning our portfolios.
One of the reasons why we think gold will continue its rally is back to the uncertainty of the geopolitics, which is largely linked to US dollar, which Steve has already mentioned. Basically, we witness the weaponization of the reserve currency on payment. And we begin to see central banks are now providing less and less fiscal backing on recognizing the reserve currency. And they're looking to redeploy their reserve, redeploy their assets somewhere else. And there's no better choice than gold as a result. Secondly, now we have the Liberation Day. Now we have the eroding fiscal backing on the Fed currency. And then we have a general trend of the weakness of US dollar, which the Trump administration openly would like to see, whether it's through currency depreciations or whether it's through rate cut. Basically, is to rebalance trade, is to reindustrialize US, right? To make it great again. Many of our clients have allocated some to gold and precious metal, but by and large, still very underweight or have not done so. So if gold and precious metal as a block has become a core and not just a peripheral allocation in the average portfolio, so imagine that. Then we are likely to see the second half of the rally stronger than the first half. And then maybe by then we'll start to call the top or the bubble, but we are definitely not there yet.
So yeah, in a long-only portfolio, we have around 6.5% allocation to gold, which is higher than most. I think we are still bullish on the outlook for gold. So we've got a 4,800 target, which wind back to mid-December when we published that looked very bold. Today we're $150 away from it, right? So we're very close already. For us, the number one thing I think to focus on from a gold perspective is continued emerging market central bank demand, right? So the sanctioning of the Russian central bank in 2022 really sent a shockwaves through the central bank community, saying if I own US government bonds and I'm sanctioned, then basically I don't have access to my reserves. So central banks, rightly so, if they're saying I'm not 1,000% aligned with the US and Europe politically, then it makes sense for me to diversify into other areas outside of US treasuries and European government bonds as well. From our perspective, that means that we're going to see a structural rise in the price of gold going forward. Obviously, there are diversification benefits as well, but even on a standalone basis, we think it's going to be a good asset to have in your portfolio. Every time gold goes down, we think central bank demand will increase, and it'll just lead to a rising trend.
Right.
In terms of silver, so we sort of see, the way we think about this is gold is part of a foundation portfolio. Silver we see more as an opportunistic trade. Our sense is silver's looking overextended in the short term, maybe overbought. Institutional investors are overweight. So there is the risk of a significant shakeout in silver.